Hi everyone, Rick Orford here, and thank you so much for joining me for today's live class. I am super excited to see you here, and I'm excited about our class today because I've invited a special guest who's an expert in passive real estate investing to speak with you all today. Brian's been in real estate for over 20 years and has done everything from flipping houses to rental properties to real estate crowdfunding. But the way he invests today is in passive real estate syndications. And this is something that I confess I haven't always understood, which is why I wanted him to come to teach us about passive investing in real estate syndications. I've heard about investors earning crazy high returns on them, which is incredible. And at times it sounded too good to be true. So I'm really excited to hear today what Brian has to say about that. Also, Brian showed me the kinds of deals his investment club is investing in every single month, and I think they're pretty awesome. You know, you get none of the headaches of landlording, but you get all of the same benefits like passive income, appreciation, and not to mention those incredible tax advantages. I also spoke to Brian to showcase real numbers from the syndicators that their investment club has worked with. Because that's one of the main questions I get about syndications, is the track record that syndicators have delivered to their investors. And that's what's so important. And I know that you'll have your own questions as well. So get them ready. We'll have a Q&A line open throughout the presentation, especially at the end. So please stay on because we want to make sure to answer all of your questions. So without further ado, let's kick things off. Allow me to formally introduce you to Brian Davis, co-founder of Spark Rental, veteran real estate investor, citizen of the world, and one of my friends. Brian, thank you so much for being here. I'm excited to hear from you. And I know everyone else on the classes as well.
Thank you for that glowing introduction. I very much appreciate it. I'll try to live up to it. On that note, I'm going to turn off my camera so I don't distract you guys with my foxy middle-aged man good looks here. Let's dive in because we have a ton of content to cover today. So I do have to read a quick disclosure per my attorney. Spark Rental is not a registered seller of securities. We do not sell investments. This class uses sample returns to explain concepts. Spark Rental does not make any warranties about specific investment returns. Spark Rental also does not receive any commissions or fees from syndicators. We don't have a fiduciary relationship with any of these syndicators. So, all right, now that we've gotten that out of the way, stop me if this sounds familiar. You work 40 plus hours a week. You don't fully control when and where you work. You don't fully control your income. If you lost your job, you'd be in a lot of trouble. So this is the journey that we want to go on together, starting here today. Point A, where you are today, is you probably rely mostly on active income, like your W-2 job, or if you're self-employed, that income. Your work really dictates your hours that you work and the location where you live and work. You probably pay the regular income tax rate on your income, the 12 to 37% tax rate, and you probably earn between 1 and 10% on average between your savings accounts, your bonds, your stock investments. So those kinds of average returns. That's where you are today. Where we really want to go, point B, where we are headed, is that you are earning significant passive income streams, that you are not just relying on your W-2 job or your self-employed gig work or business, that you choose your ideal work, you're doing your dream work, your passion work, and in part of that, in doing that, you get to choose the hours that you work and the location where you work. Or you could retire, of course. That's on the table as well. And that you pay 0 to 20% in taxes on your returns as opposed to those regular income tax rates. And you earn crazy high returns. You earn 15 to 50% or more average on your passive real estate investments. This is where we want to get. So my pledge to you is that in an hour from now, in 1 hour, you are going to think very differently about both investing and your lifestyle goals. So you can hold me accountable to this pledge. We will actually revisit this slide at the very end, and you can let me know if we achieve that. Now, who am I to talk? Why should you care what I have to say? We're not going to spend a lot of time talking about me. This is not about me. This is about you and about reaching your goals. But you want to make sure that you're in good hands, right? So I started as a hard money lender, account executive back in 2003. I was working for a hard money lender doing purchase rehab loans for the most part for real estate investors. I saw all these real estate investors making crazy high returns on their flips, on their rentals that after renovating and keeping them as rentals. So I bought my first rental property in 2005. I've owned over 20 properties directly, direct ownership, me on the title. I currently own an interest in around 1,500 rental units, and I have served as a guest expert for hundreds of publishers. A few of those being listed there on the left. And my co-founder, Denny Sipli, has also been a landlord for many decades. She's an active realtor and property manager to this day on the side, and has also served as a guest expert for these publishers. But what the real reason why you should pay any attention whatsoever to me is that I actually live this stuff. I actually walk this talk. And I get to live overseas with my wife and daughter. We spend 10 months out of the year abroad, and I get to work whenever I want. That picture up at the top left, by the way, last December, I took a month off to travel Argentina. That's us in Tierra del Fuego, hiking in Ushuaia, which is down at the very southern tip of the world, down at the southern tip of South America. So that is the real reason why you should care, why I'm here talking about this stuff. So on that note, most people start their careers on the left-hand side of this cash flow quadrant. And by the way, you are probably familiar with this, guys. This is Robert Kiyosaki's cash flow quadrant. So if you've read Rich Dad Poor Dad, if you've listened to any of his stuff, watched his videos, podcasts, read any of the books, you're probably familiar with this. So most people either work for someone else as an employee, or they work for themselves, being self-employed, but they're still trading their time for money, right? Either way, you go in and you work all day, and then at the end of the month, you get money, you get a paycheck. Most people start their careers here. Most people end their careers here. This is where most people stay. This my cubicle back in Baltimore, circa 2003, working for the hard money lender. Kind of depressing, right? Despite the little Christmas tree over on the on the side there. Freedom comes from the right-hand side of this cash flow quadrant. It comes from either being a business owner, so you can potentially continue earning money even if you're not working. You have employees who work for you, or being an investor where your money is working for you. But this is where freedom comes from, right? The right-hand side of this quadrant. So let's just illustrate this really quickly with some passive income streams from investments. So I once had a rental property. It netted me around $250 a month. So if I wanted to earn more passive income, what would I do? I could buy more of these properties, right? So with every one of these properties that I buy, I would add another $250 a month in passive income that I collect every month, right? So if I bought 10 of these, I'd have $2,500 a month coming in as passive income. Now, does anyone out there have 10 separate rental properties? Do you own 10 properties? Anybody? If so, then you probably have hit the brick wall at some point, right? So for me, after 10 properties, I ran out of money to invest with, right? It takes money to invest. I ran out of time to manage these properties. I ran out of time to find deals on these properties, because that takes a lot of time too. And I also ran out of time to be hassling with contractors, which, if you've ever worked with contractors, they can be difficult, to put it mildly. They can be a bit of a pain. So, that says nothing, by the way, of all the losses that I had because I didn't take the time to learn the fundamentals of real estate investing. I was in my early to mid 20s. I thought I knew everything, and I went out there and I invested a bunch of money in properties and didn't have a coach, didn't have a mentor, and I made a lot of expensive mistakes. Really, really expensive mistakes, like six-figure mistakes. Now, my goal of financial independence and retiring early was not the problem. I knew that if I saved and invested enough money and built up streams of passive income, I could reach FIRE, acronym for financial independence, retire early. But in my haste to jump in and get started, I got in way over my head. Like I said, I made a whole bunch of mistakes. It doesn't mean that my goal of reaching financial independence was wrong, or that real estate was the wrong way to get there. Those were both valid. The problem was that I didn't take the time to learn what I was doing. Real estate has all kinds of benefits, right? Especially for reaching financial independence. So real estate comes with really strong returns. At least it can if you do it right. It has low correlation to stock markets, which means that you actually benefit from diversification, right? It comes with great tax benefits, and by the way, we will talk more about those shortly. It is inflation resistant. People pay the going rate for housing because they need a place to live, right? So whatever the value of the currency in that moment, people will just adjust what they're paying to have a roof over their head, right? Real estate appreciates over time, and best of all, it generates ongoing passive income. So when you buy a property, from day one, you start receiving passive income, and it just keeps flowing until the day you sell that property. Now, there are some downsides with real estate, right? Real estate has a very high cost of entry, typically $50,000 plus in down payments, closing costs, initial renovations. You need a lot of cash on hand to invest in real estate. That's a big barrier to entry for a lot of people and a big downside. It is very slow and expensive to buy or sell real estate. Just another way of saying that is that it's illiquid. It's not a liquid asset that you can just buy or sell instantly, or for free for that matter. And like we touched on a minute ago, there's a high skill level required to invest in real estate, at least if you're going to do it without losing your shirt. And finally, there is a lot of labor required, both to buy properties, to go out there and find good deals on properties, and to manage them. And again, we touched on that before too. Hitting that brick wall of you get to a certain number of properties, and you just can't do it yourself anymore. You run out of time to do it. So these are some very real downsides to investing in real estate. So the question then becomes, how do you get the benefits of real estate investments without those drawbacks, right? And by the way, you'll see, I love goofy AI images. So you'll see quite a few of these kind of quirky AI images, including this one, by the way, throughout this presentation. So hopefully you find them amusing like I do and not scary like some people do. So enter real estate syndications. And this is what we're going to be talking about today, how you can get those upsides, those benefits of real estate without necessarily having any of those downsides. So what are real estate syndications? These work as following. So you have a commercial investor. They go out and they find a deal on, let's say, an apartment complex, right? That's going to cost them tens of millions of dollars to buy. They don't have tens of millions of dollars sitting around collecting dust, right? So what they do is they go out and they probably get a loan for some of it, maybe 50 to 75% of it. That still leaves them with millions of dollars short that they need to come up with, right? So what they do is they go out and they raise that money from passive investors like you and me. So we buy into these deals as fractional owners in the property, or the fund of properties. We'll talk more about that in a moment. We buy in as a limited partner. Now these are medium to long-term deals, 2 to 7 year hold periods typically. Can be a little bit shorter, maybe it could be a little bit longer, but that's the typical time frame. These are not liquid. Once you buy in, you are in. So that is something to keep in mind. The returns are crazy high, or at least they can be. No promises on returns, right? Hence the legal disclosure at the beginning. But this is what attracts people to real estate syndications in the first place, are the high returns. And we'll talk more about those in a moment. You also earn passive income typically while you own the syndication, and they appreciate over the course of that time as well. These are completely passive on your part. You do not have to lift a finger other than writing a check or, really sending an ACH payment or a wire. But yeah, you just send in the money, you become a fractional owner here, and that's it. Your obligations are done. As opposed to, say, becoming a landlord, right? Now, we used the example earlier of an apartment complex, and that is what a lot of these are, multifamily properties. But they could also be mobile home parks, they could be commercial office buildings, could be industrial buildings, these could be self-storage facilities. You could invest in RV resorts / campgrounds / marinas. You can invest in oil and gas or other mineral fields or extraction. Could be timber yards, could be agricultural. It could even be a vineyard. We've seen real estate syndications where the underlying investment are vineyards, which is kind of fun and different, right? So the first question that people ask with real estate syndications, once they get the basic concept that you're buying in as a fractional owner in these kind of larger deals, is they want to know, are the returns actually this high? Like, I mean, is it actually possible to earn like triple-digit annual returns on these, or even the 12, 15, 20, 30% returns? Like, how realistic is that? And the answer is quite realistic. So here are 4 syndicators who we have worked with in the past, and these are the average annualized returns that they've delivered across all of their deals for their syndication investors. So MAG Capital Partners, average annualized return across all of the deals that they've completed, 20%. Bronson Equity, 28.6%. Wolf Investments, 67.7%. Rise 48, 70.5%. And again, this is the average of every single deal that they have gone full cycle on and sold. These are pretty impressive average returns, right? So yes, it is the bottom line. You can really earn that. And here, I'll give you a quick example. This is Rise 48. They've done, I think, around 70 deals total. And of those 70 deals, 11 of them have gone full cycle, where they've totally finished the renovations and stabilizing the rents and sold them and returned all the money to the investors, including the passive investors like you and me. So here, this is a list of those 11 deals. And the important numbers here are, if you look down at that red circle number at the bottom, the projected IRR, or internal rate of return, that's irrelevant for this conversation. That's the annualized return. If we want to avoid getting lingo-y about it, linguistic, whatever the adjective of lingo is. So they projected a 15.5% return on average for these 11 deals. What they actually delivered, if you look at towards the bottom right here, actual IRR that they delivered on these annualized return was over 70%, right? So point is, these are real returns. Now, we can compare those to other types of investments. This was a study done by the German central bank and several US and German universities. There was a joint study where they looked at 16 now wealthy countries, mostly in the US and North America, and they compared the returns on 4 different types of assets over 145 years. And here is what they found. The average annual return across these industrialized countries, adjusted for inflation, that they found that residential real estate returned a little over 7% on average. They found that equities, which is stocks, returned on average a little under 7%, 6.89% on average. Bonds returned around 2.5% on average. And treasury bills, so very, very short-term bonds, 1-year bonds, a little under 1% on average. So this is what we're comparing it to, right? These are the average annualized return over the very long haul. So let's look at what this would actually do for you as an investor. If you invested $5,000 a month for 10 years at just 1% returns, such as those treasury bills or such as you might earn on a savings account, after 10 years, you would have a little over $633,000 with those 1% returns. At 5% returns, and we're going to be generous here with bonds because bonds actually, if we looked at this, 2.5% is the average return on bonds, right? But we're going to be generous and we're going to double that to to 5% returns. After 10 years, you would have $762,818. With stocks and rental properties, so 7 to 10% returns. And again, we're being generous here. Both stocks and rental properties, historically have returned around 7%. We're going to bump that up to 10% to give them the benefit of the doubt. So again, after 10 years, you would have around $969,000 investing at 10% returns. If you earned 20% on average on your real estate syndications, you would have around 1.6 million after 10 years, 1.5 or 1,588,000 and some change. And if you earned a high-performing syndication return of 30% on average, then after 10 years you would have $2.6 million, more than $2.6 million. So you can see the difference here in the long-term results for you as an investor, depending on what kind of returns you're earning here. These are very real numbers. So, on that said, you guys with me so far? Are you following this? Because we're about to take this to much more. We're going to get a little more complicated here. We're about to make the jump to light speed here. So, there's a concept in real estate investing called infinite returns. And this is considered by many to be the holy grail of real estate investing returns. So before I introduce this concept, we got to take one step back and talk about the two different exit strategies that real estate investors have, and in particular, real estate syndicators use. So after you buy a property that needs some renovations, it's outdated, whatever. So you buy it, you go in, you renovate it. Once you have finished the renovations and stabilized all the rents, you sell the property, you take the profit and you walk away, right? Every partner on the deal gets paid out, the deal's closed, it's done, right? So with syndications, typical timeline on those types of deals, 18 to 36 months, right? So you guys are following me. This is basically a glorified flip, right? You buy an apartment complex, renovate everything, raise the rents, and then sell it. Alternatively, after doing those renovations and stabilizing the rents, you refinance instead of selling. So in this case, you return some, or not you, but the sponsor, the syndicator, returns some or all of the passive investor's capital to them. So they return some or all of your and my initial investment back to us after refinancing the property, right? But we keep collecting cash flow. We retain our ownership interest in the property. We keep collecting distributions every month or every quarter. And then we hold the property longer, right? Because we already got our money back. So now it's all upside. So we keep collecting the cash flow. The property keeps appreciating over time. And the typical timeline for these before selling is usually more like 5 to 8 years, maybe even longer, because really there's no impetus to sell, right? If you already got your money back and you continue earning cash flow and the property keeps appreciating, then there's really no reason to sell, right? Because you keep your ownership share, you keep collecting distributions, property keeps appreciating. But if you got all of your money back, then every dollar you earn after that point is an infinite return on your investment of $0, right? Does that make sense mathematically? So if you no longer have any money tied up in this property, in this investment, then every dollar you earn represents an infinite return on your investment of $0. So let's walk through a quick example here. Let's say that before the property refinances, you're earning an 8% yield on it. So let's say you invest $10,000 in a syndication. You're earning an 8% yield. That's $800 a year in passive income and distributions, right? Then the property refinances. You get back your $10,000 investment. You still earn $300 per year. Now, it's a lower dollar amount, right? Because you now have more debt on the property. So the cash flow gets narrower on the property. But you got back your $10,000 investment. You're still earning the $300 a year in passive income. So you take that $10,000 and you go ahead and reinvest that in another deal, or in stocks or whatever you want. But you can see that you snowball your income because you get to recycle that same $10,000 investment over and over again, because you get the money back when the property refinances. So if you guys are like me, you're a visual learner. Do we have any other visual learners out there? You like to? This might make more sense if you see this visually. So you have your one-time $10,000 investment. The pretty little green illustration up there of the stacks of dollar bills goes into a syndication. You're earning $800 a year in total passive income, right? Then it refinances. That cash flow drops to $300 a year, but you get your $10,000 investment back and you reinvest that in a second real estate syndication. So now you're earning $300 a year on the original one, plus $800 a year on the new one. So that's $1,100 total passive income, right? Again, this is all on the same $10,000 investment on your part. So then that one refinances and the cash flow drops down, but you get your $10,000 back and you invest it in another syndication. So now you're up to $1,400 a year total passive income. And then that one refinances and your $10,000 goes into a new syndication. Now you own 4 real estate syndications, right? And your total passive income is $1,700 per year on this. And then that one refinances, right? So now you own 5 real estate syndications, all with the same original $10,000 investment, and so on and so forth. You get the idea. I don't need to beat it to death. Now what happens when these start selling, right? When you start selling these deals. So that first one that you did, the original one, let's say that one sells. So you get $10,000 in profit. So you get another. So you already got your $10,000 original investment back, right? And then you reinvested that in other syndications. You hold that for 5-8 years, or the sponsor, the syndicator holds it because you're not actually making the sale decision on these. But you held it for a while. Now it sells. You get $10,000 in profits from that sale, right? So you stop getting cash flow on it, right? Because the property is sold, but you get $10,000 in profits from appreciation from that property. And then the second one sells, and you get another $10,000 in profit. So then the third one sells, and you get another $10,000 in profit, and so on and so forth. So the cash flow from these disappears because you sold the property. You slaughtered the golden goose, as it were, but now you've cashed in on the appreciation. So you can see how these compound faster, right? So you guys with me? You digging this? You see what's happening here? So these compound way faster than most investments if you are pursuing infinite returns, right? And the best part of this is that there's no labor required on your part. So you get all of those benefits of real estate that we talked about earlier, right? The strong returns, the low correlation to stocks, the tax benefits, the inflation resistance, the appreciation, the ongoing passive income. You get all of that without all the hassles of trying to line up financing with lenders, mortgage lenders, having to deal with contractors and negotiating with them and nitpicking about how they didn't do the crown molding right, hassling with city inspectors, messing around with tenants and the 3 a.m. phone calls about leaky toilets or about how a light bulb burnt out, or you don't have to manage property managers and you yell at them to go actually do their job and go inspect the property, every 6 months or every year or whatever. So you can see that you get all those benefits, but it's a passive investment. You don't have all the headaches that come with flipping houses or becoming a landlord. So you saw this screen earlier. We showed you like that example of how if you bought 10 rental properties that each cash flows at $250 a month, that's great, but that took me thousands of hours of work to actually go out and buy and renovate and manage those 10 rental properties. That was a ton of work to do that. If you were to go out and invest in 10 real estate syndications, the work required on your part is like 5 to 10 hours worth of work, right? I mean, it's just the initial vetting of the syndicator and vetting of the deal. Like, do I feel comfortable writing a check to this person and then writing the check? So you get those benefits, you get that passive income without all the labor. is the bottom line. So my question to you, would you prefer to spend your nights and weekends and free time landlording or doing this, doing, traveling with your family is how I spend my free time, but you might be doing it something else entirely. Maybe you love bowling or whatever, but that's my question to you is which would you prefer? Now, this is not a get-rich-quick scheme, right? It's important to note that these deals, the typical timeline on these deals, remember, syndication deals, you're looking at 2 to 7 years on average. For the first 6 months, it's usually like a set it and forget it. Like you're not typically earning any distributions in the first 6 months. The sponsor, the syndicator is going in and they're stabilizing the property management and just making sure that everything is running smoothly. Usually around 6 months after you invest, give or take 3 months. Sometimes it's very quick. Sometimes it's within the first 3 months. Sometimes it takes longer, like 9 months or a year before you start getting distributions. But you do typically, you collect distributions starting around 6 months after you invest in a syndication. And for those for that next 2.5 years or so, from like 6 months to like 36 months out, roughly speaking, you're collecting distributions. The sponsor is busy renovating the property or stabilizing it. Maybe they're adding more buildings to it or whatever. But you get to sit back and collect distributions at that point. After 3 to 4 years, the sponsor will either sell or refinance the property, like we talked about a minute ago. If they sell, then everyone gets paid out. The end, done. If they refinance and hold the property, then you get to continue just collecting distributions, right? And then after 5 to 8 years, then the property will typically sell and everybody lives happily ever after, right? You can take the money from either the refinance or the sale and reinvest it in either more syndications or go out and, buy stocks or buy rental properties or buy a yacht or whatever it is you want to do. So are you guys with me so far? Is this making sense? And by the way, do not be shy with your comments or your questions in the chat. Seriously, we're taking questions throughout, and we will be doing a Q&A at the end. I'll be answering some of these questions at the very end. All right, let's talk tax benefits here, because this is one of the big reasons why people love real estate, and in particular love real estate syndications. And like I said, some of these pictures are a little scary. That woman's a little scary. All right, so tax deductions. First of all the normal tax deductions that real estate owners get, those do carry through to you as a passive investor in these deals. So what happens is the syndicator will add up all the revenue and they'll subtract all of those same deductible costs, right? Loan interest, some of the closing costs, property management costs, repairs and maintenance, property taxes, property insurance, all that stuff. Those are deductible expenses. They get subtracted from the total revenue, and you will get a K1 at the end of the year showing that bottom line number with those deductions already removed from it. So you get a K1. This is what a K1 form looks like. That field number 2 there is the net income or loss that will appear, that you just plug into your tax return. You don't have to do any of the work of calculating this or any accounting. You just get a number to plug into your tax return. And then field 19 here is the actual distributions that you received. Now these are going to be 2 very different numbers, and I'm going to show you why in just a moment. So this is the power of depreciation. Now you may not be familiar with this, but did you know that you can write off the cost of the building itself, or the value of the building, upon purchase? So the way this works is you get to deduct the value of the building, but you have to spread that deduction over the course of 27.5 years. So let's say that you were to buy a building that's worth $1 million. You don't get to write off a deduction of $1 million in that year, right? You have to divide it by 27.5 years, and so that comes to $36,364 per year that you can then deduct from your taxable income. Each year for the next 27 and a half years, you get to write off that amount as depreciation. Now, what sponsors do, what syndicators do, is they actually accelerate this process so that they can deduct even more for depreciation in the very beginning, since they're only going to own this properties typically for 2 to 7 years, right? So they want to take as much as possible for depreciation. So what they do is they bring in an auditor and they do something called a cost segregation study, which reclassifies as much of the building as possible under different tax categories, such as personal property. So these different categories of assets within the property can be depreciated over shorter time periods. So maybe 5 years, 7 years, 15 years, instead of that full 27 and a half years. So the upshot is that you get to show losses on your K1. So you get to show losses on your tax return to offset your other income, even though you did collect real cash flow. In the real world, in your real bank account, you collected money. You collected real dollars. So here, this is an actual K1 form showing a loss, a net loss of over $20,000, even though you collected $1,100 in real distributions in that year. So you get to take that $20,000 loss and use it to offset other streams of passive income. So for example, dividends from stocks. You can offset that income with these passive losses. You cannot use it to offset active income though, like W-2 income from your job, for example. Now, what if you don't have other taxable passive income to offset? You can just carry this loss forward to the next year. So next year, maybe you will have other sources of passive income that you want to offset. And you can do that by just carrying the loss forward. And when the property sells, you'll definitely want this, because you're going to earn a big payout when the property sells. So you're going to want to, or you can carry this loss forward to offset that in the future. So if you don't have other passive income right now to offset, it's okay, it's not a big deal. You can just carry the loss forward on your tax return and use it in the future when you're ready for it. Now, you do not have to pay self-employment taxes on your returns on your real estate syndication investments. And because these assets are always held for longer than a year, the profits on these, when they sell, are always taxed at the long-term capital gains tax rate, which is between 0 and 15% for most Americans. If you're earning like $500,000 a year or more, then you'll hit that 20% tax bracket for long-term capital gains. But for most of us, you're paying between 0 and 15% in capital gains taxes. You can compare that to 10 to 37% for regular income tax rates. So you know how your rich friends, love real estate and how they never seem to pay taxes? We all probably have one of those friends, right, who's like into real estate and never seems to pay any taxes. This is how they're doing it, right? It's through depreciation. You can also invest in tax-sheltered accounts, such as a self-directed IRA. So you just have your self-directed IRA custodian wire in the money to invest in a real estate syndication deal, and then you're done. You're off to the races. It's way easier than buying an actual rental property with your self-directed IRA. And this is another thing that wealthy people do to avoid paying taxes on their real estate investments, right? They open a self-directed IRA. The process is actually pretty simple, and if you need a recommendation on one, we can send you some. In fact, we can hook you up with some that offer free strategy sessions for you. So this is something you can do to avoid having to pay taxes on your returns, especially if you set up like a Roth self-directed IRA. Or if you don't feel like opening up a self-directed IRA, then use your regular IRA or your 401k to invest in stocks, and then invest in real estate outside of that, right? So, I invest in stocks and real estate. I invest in stocks through my IRA accounts and other tax-sheltered accounts, and then I invest in real estate outside of it because real estate comes with great tax benefits anyway, like we just discussed. So it's not either or with investing in stocks or investing in real estate. I invest in both and get the diversification benefit. So if stocks have a bad year, like for example they did in 2022, my real estate investments still did fine. I still collected distributions in 2022, and still collected that cash flow. So it's not either or, it's both, and it's spreading risk by investing in many different asset classes. Now, a lot of you, let me know if this is what you have been thinking so far. Is this, hold on, wait a second here, 12 to 120% returns on completely passive investments, full tax benefits. There's got to be a catch, right? Like, what's the catch? So, has this thought been going through your mind? You've been wondering, like, what's the catch here? Yeah, there are some things that we need to talk about with these, right? So first of all, historically, these have been what we call like country club deals, right? They're passed word of mouth between wealthy buddies, wealthy friends, or with by investment advisors who work for wealthy clients. That's historically where people have heard about these, and the SEC historically has only allowed wealthy investors, accredited investors, to invest in these. And by the way, if you're not familiar with that term, an accredited investor is someone who has a net worth over $1 million, or who earns over $200,000 a year for singles, $300,000 a year for married couples. I don't want to get in the weeds of all that, but basically, some real estate syndications only allow accredited investors based on SEC regulations. Now, there are some, however, that allow non-accredited investors. These are called sophisticated investors, because you should know your ass from your elbow to invest in these. You should be sophisticated enough, something about real estate. But some deals, which are classified as 506B deals, as opposed to 506C deals, which only allow accredited investors, 506B deals, it's a different regulation category from the SEC. These do allow non-accredited investors. So yes, you can access these if you are not rich, or not rich yet, we should say. So your first quest as an investor looking to invest in real estate syndications, if you are not yet an accredited investor, is to find sponsors, find syndicators who offer 506B deals. So how do you beat level 1 here, right? Like, how do you find sponsors who allow non-accredited investors if you are not yet one? You can ask for referrals from friends if you have some wealthier friends who invest in this space. You can go online to forums and ask, where are other people investing? What are some sponsors who they like? You can go on social media groups like Facebook groups that specialize in these and ask about them. You can listen to podcasts. So for example, the How to Scale Commercial Real Estate podcast with Sam Wilson is a great one. He brings on sponsors, syndicators all the time. You can invest through a real estate investing club, like ours, for example. This is what we do. So every month we invest in a real estate syndication deal like this. And here are the 4 examples we gave you earlier, right? Like Mag Capital Partners, Bronson Equity, Wolf Investments, Rise 48. These are examples that we already gave you earlier in sponsors who do allow non-accredited investors. So. All right, quest 2 for these is how to minimize risk. How do you minimize your risk in real estate syndications? Because every investment comes with risk, right? Stocks come with risk, bonds come with risk, real estate rental properties come with risk, real estate syndications come with risk. So one risk is inexperienced sponsors who don't have a lot of deals under their belts, who don't have a proven track record. That is a risk. Unethical sponsors. If someone took your money and ran off to a third world country, that would be a risk, right? Poor property management could be a risk. Rising vacancy rates at the property would be a risk. Loan risk. There is risk of interest rates going up, or loans expiring, and it potentially being a more difficult environment for borrowing money when the loan expires. Cap rates rising can reduce the value of these sorts of real estate investments. So these are risks. So how do we beat level 2, right? Like, how do we reduce risk on these and keep the risk very low even while pursuing high returns? So the first thing we can do is have a detailed way of vetting sponsors. Because remember, sponsors, having inexperienced or unethical sponsors, or sponsors who don't have a great property management company in place, that's a risk. So how do we minimize that risk? By vetting sponsors really carefully. So Denny and I have a checklist with over 40 questions and points that we confirm with sponsors. And we're not going to go through all that right now because we'd be here all day. But some of these include, do they even work with non-accredited investors? Because if you're not an accredited investor, then why even bother continuing the conversation, right? if they are not able to work with you. What types of properties do they focus on? Multifamily or industrial or self-storage facilities. And there's no right or wrong answer with that, but you want to know what is their focus, right? Where do they invest geographically? What cities? Why? Why do they invest in those cities? Are those cities investor friendly, or are they really tenant friendly? What's their investing strategy? Do they go in and buy properties that need a lot of renovation work? Or do they go in and buy like more or less turnkey properties that are already operating really smoothly? Do they try to find distressed sellers to get a good bargain on properties? Again, there's no right or wrong answer here, but you want to understand their investing strategy and their investing thesis and why they do this. What's their typical exit strategy? Do they sell the property as soon as possible, or do they refinance it to try to pursue those infinite returns that we talked about earlier? And again, there's no right or wrong answer there. Some people would rather just get the money back from selling right away, or as quickly as possible, and just move on to the next deal. Other people really like the idea of pursuing those infinite returns. What fees do they charge as a sponsor? You ought to understand that, right? How often do they pay out distributions? Is it monthly? Is it quarterly? Is it annually? Most importantly, though, look at their track record. What have they done in the past? Right? How have they performed in the past? How many deals have they done? Of those deals, how many have gone full cycle? Right? So the example we gave earlier of Rise 48, they've done around 70 deals total. Of those, 11 have gone full cycle. What was the average annualized return on those deals that have gone full cycle? Right? For Rise 48, it was over 70% annualized returns that they delivered back to their passive investors. Have they ever lost money on a deal? Which is not necessarily a deal breaker if it was an early deal that they did. You want to know what did they learn from that? Have they ever done a capital call? That's a bigger red flag actually to me. Is a capital call is when they come back and ask investors for more money. That's a big red flag. That's a no-no. Now, part two of this is not just vetting sponsors, but vetting the individual deals themselves, right? Like the individual properties. So is this property in an investor-friendly city and an investor-friendly state? Is there a low break-even occupancy rate? So if you're not familiar with that term, so occupancy rate is just what percentage of the property is filled up with tenants, and you want to know what's the current occupancy rate upon purchase. Maybe it's 90, 95%, and then what is the occupancy rate at which the sponsor or the deal would start losing money. So you want that to be as low as possible, right? And you want as big of a gap between those two as possible. So, if the current occupancy is like 95% and the break-even occupancy is 65%, then you've got a lot of wiggle room there, right? There's a huge gap between the current occupancy rate and how low that occupancy rate would have to fall for you to start losing money and for it to become cash flow negative, right? So does that make sense? You guys with me so far on that? All right. What is the loan to value ratio on this? And this is just like with a home mortgage. This is the percentage of the property's value that the loan amount covers. So if the property is worth $10 million and you take out a loan, or the sponsor is taking out a loan for $6 million, then that's a 60% loan to value ratio. And the lower the LTV, the more conservative the deal, then the safer the deal. Are there favorable loan terms? Is the interest rate low? Is the term extendable? So on and so forth. Is there a contingency plan, or what are the contingency plans? Can that loan be extended if they need an extra year before refinancing or selling the property? What's the exit strategy for the deal? So you ask the sponsor about those contingency plans that they baked in when they planned this deal. And finally, how conservative is the underwriting on the deal? Did they plan on a really, really low cap rate to have a really high multiple basically of the revenue, or is it more conservative? Did they plan on a more realistic cap rate? Did they do a comparison chart showing what the returns would be at different exit cap rates, at different average rent increase rates? So you want to see that they took that underwriting seriously and that they are showcasing what the returns would be under different scenarios, so that you have a better sense of the range of possible returns on the deal. Now, the flip side of this is that real estate syndications actually avoid many of the risks that often come with real estate investing. So some of these normal real estate investing risks don't apply to syndications. So legal liability is one of those. As a limited partner, you don't have any legal liability whatsoever. No one can sue you. Which is not the case for landlords, and I can tell you that firsthand. I have been sued several times as a landlord. People love to sue landlords. I don't know why. People love to hate landlords. You don't have any loan liability. You are not signing as a personal guarantor on the loan. So if something happens and the sponsor defaults on the loan, you're not liable. So, and again, that's not the case with going out and buying a rental property or flipping a house. You do take on loan liability. You do sign a personal guarantee on those mortgage loans. You don't have the risk of emergencies or tenants calling you at 3 a.m. saying that the roof caved in. You don't have those headaches. So, all of those property management related headaches and the emergency phone calls, you don't have to deal with any of that. Those risks don't apply to you as someone who invests in syndications. You don't have to go to evictions or court appearances. You don't have to file evictions or call the tenant and let them know that they're 2 months behind, and if they don't catch up, they have to all that stuff you don't have to deal with as a passive investor in these syndications. And finally, you don't have all the tax complications that come with owning properties directly. You don't have all the complicated accounting. You just get a K1 and you plug that bottom line number into your tax return and you're done. So, and by the way, you don't have the risk of incorrect reporting with the IRS coming after you and saying, oh, you cheated on your taxes, blah, 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 because you just messed up the accounting with your rental properties. That doesn't happen here because, again, it's all done for you. You also don't have the risk of home prices losing value, that is a risk when you go out and buy rental properties, right? There's the risk that the rental property go down in value. This is just a chart showing average medium home prices in the U.S. over the last 70 years or whatever, 60 years. But real estate syndications, these commercial buildings are priced based on income, not based on home prices. And income, obviously based on rents. Rents are really smooth. Rents don't drop during recessions. At worst, they flatline. Like if you look at the Great Recession, rents didn't go down. They just flatlined for a couple years. So you don't have that risk of property values dropping because the rental income just keeps flowing in. And rents don't go down, even in recessions. All right. Quest number 3 is reducing your minimum investment with real estate and with syndications specifically. But coming up with $50,000, $100,000 to invest in either a rental property, with the down payment and the closing costs and the renovations, or investing in a syndication, because syndications do typically require a similar minimum investment of 50 grand or more. That's a lot of money, right? For the average person. And even if you have that money sitting around ready to invest, it's hard to diversify when you have to park 50 grand, 100 grand in a single investment. So that's a challenge for most of us. Now, here's the thing though. You don't need $50,000 to $100,000 to invest in a real estate syndication. You just need to join forces with other like-minded investors who want to do this. So it's kind of like Captain Planet, right? Like with our powers combined, we are Captain Planet. So the loophole here with these real estate syndications is that even though the minimum investment is typically around $50,000, you can pool your funds with other passive investors under a single LLC to invest together in that syndication. It counts as one sophisticated investor. You and say 9 other investors with $5,000 apiece all come together as Captain Planet, and you've reached that $50,000 investment, right? So that means that you can do this. You can invest smaller amounts in more properties. Now, to do this, you could recruit 9 friends of yours if you have 9 friends who are into this, or you could just join a real estate investing club. This is, like I said before, this is what we do, and we'll talk more about exactly how it works in a minute. But you and 9 other people all pool your money together to reach that $50,000 minimum or whatever it is. Means less money per investment, more diversification. So that $50,000 investment can be spread across 10 different properties here, right? So $5,000 a piece in 10 different properties instead of the traditional real estate investing model where $50,000 goes into either one single rental property or one single real estate syndication. It just makes it much harder to diversify, right? So it lets you spread risk across 10 different investments, 10 different properties, because there is risk in every investment, like we talked about earlier, and you want to spread that risk across as many different investments as possible. And hey, you get to mention at cocktail parties that you own an interest in 1,500 units, right? Like I got to brag about at the beginning of this class. So let's just make up, or not make up here, but let's just walk through example returns. So let's say that you have $50,000 that you spread across 10 different properties. So you have one in Dallas that ended up paying a 15% annualized return. You got one in Nashville, 26%, one in Phoenix, 12%, one in Kansas City, 17%, Miami, 39%, so on and so forth. But it's spread across those 10 different properties. Some of them are going to underperform, like in this example, the one in Chandler underperformed at 7% returns. The one in Atlanta overperformed at 73%, right? But together, the average annualized return in this example is 24.6%. So on a $50,000 total investment, that comes to $12,300 a year, right? So, and you know how we're serious about these returns is that we invest our personal money in these every single month. So that's me and Millie on the left. You can't tell how big that waterfall is, but that's a 400-foot waterfall in Brazil. And there's Denny with her grandkids. But this is how you know that we are serious about achieving these kinds of returns. Our personal family money is in these. So on that note, who here is excited about this? Who is excited to invest in these kinds of deals every month too, the way that Denny and I do? And if you are, then I would like to personally invite you to our co-investing club and our Fire from Real Estate program. So can I spend a couple minutes showing you exactly how our investment club works? All right, I see a few yeses there in the chat. So let's plow right ahead here and talk about how the co-investing club works. So every month or so, we propose a new syndication deal. Every deal is optional. There's no pressure to invest in any one of these deals. You can abstain from any of these if you choose, or dive into every single one. The minimum investment for deals that you do join is $5,000. So the idea here is that you can diversify and spread your money across a lot more deals rather than having to plow $50,000 or $100,000 into every single real estate deal that you do. Whether that's syndication deals or down payments on rental properties, which cost in that same ballpark. We aim for average annual returns in that 15 to 30% range. Ideally more, sometimes more, but that's where we target. So we are trying to beat the stock market pretty handily here. And our goal in this co-investing club is to help you beat all of these challenges that we talked about earlier, right? So the first challenge of finding sponsors that offer 506B deals and allow non-accredited investors. That second challenge of minimizing risk and vetting these deals collectively as a club. And of course, vetting the sponsors very carefully. That third challenge of the minimum investment, we've talked about that quite a bit here, right? It's really hard to diversify when you have to come up with 50 or 100 grand for every single deal. When you can put $5,000 per deal in, it's a lot easier to A, come up with the money, and B, to diversify your real estate investments. So the process here is very simple, very easy. When a deal comes along, we send you an email with a brief summary explaining the deal, and we link to a detailed deal investment deck from the sponsor with all of the projected numbers and all the actual numbers, showing things like the current vacancy rate and so forth, the business plan, information about the market itself, the city, the neighborhood, and so forth. We send you a link to a 45 to 60 minute video from the sponsors breaking down the deal step by step. We send the sponsor's track record over when we have it for all of these deals, and we usually do have it. We usually do get these from the sponsors. And then, of course, we send an invitation to an online meeting, a video meeting, where we all get together and we bring the sponsor on to answer our questions in real time. This is how we vet the deals together in real time. So here's a sample email that we send out showing, just a quick summary of the deal, showing links to the investment deck, the video explanation of the deal, the meeting when we're meeting. So yeah, it's just a sample email that goes out. For every single one of these deals, we create a new joint LLC to invest with, and every single person is listed as a member of that LLC, as an owner in the LLC. We open a unique joint bank account for that LLC that everyone has access to view and see transactions and history in real time. We use this platform called TribeVest for this, and we can send you more information about this if you want, but it's a very simple platform for seeing banking history. Like you can see here the different transaction history for the bank account. This is how we manage votes when decisions need to be made, although that's pretty rare since this is passive investing. All shared documents such as the LLC articles of organization and EIN and all that kind of stuff. The signed PPM, the legal document that we sign with the sponsor to invest in the deal, all that stuff goes in the document section. So you can see all of this in real time for every single deal. So if you earned 15 to 30% average returns moving forward, my question to you is, how quickly could you reach financial independence? How much faster could you reach it earning these kinds of returns than the 1% savings account, the 5% on bonds, the 7 to 10% on stocks? This is what we are aiming for here. This is a way more fun way to invest, or a way more fun way to earn money than working from a cubicle. I can tell you firsthand. So here's what you get as part of this program. You get 1 year membership in the co-investing club, of course. The value there at $4,500. Now, we did not make that value up. Here's how we came up with that. If you invested the minimum amount in each deal at an average return of 15%, and at the low end of what we're aiming for, that would average you $9,000 per year. Now, that would be more than that, of course, if you invest more than the minimum investment in each deal, the minimum of $5,000 per deal. Now, let's say that you skip half of the deals, though. Let's say that you invest in 6 deals a year instead of 12 deals a year. That would bring your average returns down to $4,500 per year. That's where we came up with that number. And again, it would be more if we earn more than that 15% average return on these deals. But that's how we came up with that number. So you get the 1 year membership in the co-investing club. We also give you access to our full Fire from Real Estate course, our program, because the co-investing club is us helping you catch a fish every month. The Fire from Real Estate program, our online course, is teaching you how to fish for yourself, right? So it's like that cliche, but if you give a man a fish, you feed him for a day. If you teach a man how to fish, you feed him for life. So we're trying to help you learn how to feed yourself for life here. And by the way, don't look too closely at those people's scary teeth, right? Anyway, here are the modules in the course. The first section is all about how to boost your savings rate without a reduction in your quality of life. Section 2 is all about real estate crowdfunding and how to invest passively there, often with minimums as low as $10. So it's a good, easy starting point for passive real estate investing. Section 3, an even deeper dive on real estate real estate syndications, how they work, some of the benefits, some of the risks, how to maximize the benefits and minimize the risks, all that stuff. Section 4, all about direct property investing, buying rental properties yourself, becoming a landlord. If that is of interest to you, it's not for everybody, but some people love it. And then section 5 is all about scaling your investments and, even more importantly, living the financially independent lifestyle before actually reaching financial independence. Because I don't consider myself financially independent yet, but I still get to live the exact same lifestyle that I would be living if I were financially independent. And we dive into that because that's what this is all about, right? Living your ideal lifestyle. Here's a quick snapshot showing some of the videos in section 2. First one is an introduction to how real estate crowdfunding works. And then each of the other videos are case study videos on individual platforms. So you can see how each one of those platforms works behind the scenes. These are mostly platforms that I have invested personal money in. So I log you into my dashboard. You can see exactly how they work. We include lots of tools with the Fire from Real Estate program. So for example, we include analysis toolkits for analyzing sponsors, for analyzing deals. We give you our full list of sponsors who we have invested with or who we are signed up to hear deals from as well. And tools for measuring your progress towards reaching financial independence and early retirement, and plenty more tools to boot. Again, it's all about helping you learn how to fish for life. I love this quote here from Tim Dooley. It feels like I'm learning from a friend who knows what they're talking about. So thank you for that, Tim. So what you get 1-year membership in the Co-Investing Club. You get the Fire from Real Estate course, and you get lifetime access to that. You also get monthly calls with us. So with every single one of these Co-Investing Club deal proposal meetings that we do, Denny and I hop on early, and we also stay on late. So you can come and ask us anything you want, whether that is about the deal itself, of course, or about how the Co-Investing Club works, or about your own deals that you are pursuing as you go out and buy your own properties, or about crowdfunding, about lifestyle design, about savings rate, anything. Nothing's off the table. So join us every month for live access to both Denny and myself, and you also get ongoing email support with the two of us and with our entire team at Spark Rental as well. So 1-year membership in the Co-Investing Club, full Fire from Real Estate program for life, ongoing calls and support with us. And the second bonus is access to our accountability group. So this is a community of other, what we call firewalkers. I know, I'm such a big nerd here. But a private Facebook group of other people who are pursuing financial independence with real estate. We assign accountability partners, and this helps keep you on track. And countless studies show how effective this is. One study by the American Society of Training and Development found that people were 95% more likely to meet their goals if they had an accountability partner. So it just goes to show how much faster you can reach your goals with accountability partners. And our communities online are very active and very supportive. So you get 1-year membership in the Co-Investing Club, you get the full Fire from Real Estate course, you get ongoing calls and support with Denny and myself, and you get access to our accountability group and private community. Total value over $7,000 for the first year alone. Now, spoiler alert, we're not actually going to charge you $7,000 for this. We do want to keep this accessible and affordable. So the pricing is on the purchase page, $14.97 as a one-time payment, or 3 payments of $559 per month. This is exactly what you'll see on the page. And our goal for you is really simple. Our goal is for the returns from your very first syndication deal to cover this cost of joining. We do include a 30-day guarantee. So, if you're not sure that this is for you, no sweat. You can take the course, you can join the co-investing club, check out our next co-investing club deal. And if you're not feeling it, drop out with a full refund, no questions asked. Here are our personal emails. This is how big we are on transparency. So you can reach me at any time, Brian@sparkrental.com. You can reach Denny at Denise@sparkrental.com. We are not messing around here about being available to you. I love this quote from Mara. She says, Brian and Denny have always made me feel that they were above board and actually interested in seeing me succeed off their knowledge. If you have questions, they respond to your emails with a quick turnaround time. And again, that's what we're big on, right? Is transparency and accessibility. That's why we give out our personal email addresses here. And as a final thought with these deals that we're investing in the co-investing club, these are eco-friendly deals. We are not building ground up developments. We're not going out and bulldozing acres of forest land to build new properties. We're going into dilapidated apartment buildings and renovating them and fixing them up to improve the quality of life for the tenants who already live there. So we're taking existing buildings that are simply run down and we're renovating and improving them. So we're not building new developments, not bulldozing ground that is currently used for parks or nature or any kind of unused ground. These are existing buildings and we're simply improving them for the people who live there. Now, it's worth mentioning that if you are not interested in the full Fire from Real Estate program, that's okay. We do offer the co-investing club by itself as a standalone membership. It's $497 a year, or if you prefer to pay monthly, $59 a month, and that's it. So that's an option on the table as well. Now, my question to you, did we deliver on our pledge that we made at the beginning of this class? So it's, as a reminder, we said in 1 hour, you're going to think differently about both investing and your lifestyle goals. So tell us in the chat, did we deliver on the pledge we made for this class? All right, on that note, let's take some questions.
Brian, I love the pledge that you made at the beginning, and I can personally say, yes, you nailed it. It's a different way of thinking about your lifestyle. When you think in terms of building out passive income streams that can help you switch over to your dream work, even if that doesn't pay as well as your current day job, well, most people, even those familiar with financial independence and retiring early, they think in terms of all or nothing. Either I have enough to quit my job or I don't. But Brian, I love that you and your family spend so much time traveling overseas like I do and focus more on that international lifestyle design supported by some investment income. So I've seen a bunch of questions come in over the chat, and I wanted to make sure that we got to cover as many of these as possible. But before we dive into those, I wanted to say that this is awesome. Brian, I love what you and Denny are doing, making these kinds of high return investments accessible to everyone. And while a $5,000 investment isn't chump change, it's a far cry from the 50 grand or more that you typically need, for either investing in a real estate syndication on your own, or a down payment, closing costs, renovation costs, on your own investment property, and not to mention all of the extra time for the work that's involved. Now, I do have one question to kick things off. What happens to your existing investments if you leave the co-investing club? All right, so I'll switch my mic back off, and thanks, Brian.
That's a great question. So if you leave the co-investing club, you simply get taken off the email list to be alerted about new deals. You already own investments in whatever syndication deals you participated in. No one can take that away from you, right? So you simply lose access to being alerted to new deals. And of course, the monthly calls with us and so forth. But your existing investments stay yours. And of course, we stay in touch with you about the status of those investments. You keep collecting your distributions. When the properties sell, you get your big payout. You simply lose your access to new deals if you leave the co-investing club. And another question here, what happens after that first year? The cost of membership in our co-investing club as a standalone thing is $497 a year or $59 a month. So after that first year that's included in the Fire from Real Estate program, you simply stay on as a monthly or annual member in the co-investing club, or not. You can not renew as well. You can hit the road at that point as well. So no questions asked, no pressure. It's up to you whether you want to stay or go. Question came in: do we guarantee the returns on these deals in the co-investing club? And the answer is, of course not. we certainly cannot guarantee returns. No one can guarantee returns. These are investments. Investments come with risk. We try to minimize that risk, and we like to think that these deals have sort of mid-level risk with very high-level returns. But these are investments. They do come with risk, and we do vet these together as a club. We minimize that risk, but every investment comes with risk, and that's that. Another question was, does Spark Rental get a cut of any of the money raised for investments by the co-investing club? The answer is no. Denny and I do not get any cut of this. Our company doesn't get any cut of this. We are not selling securities. We're not raising money on behalf of sponsors. So we do not get paid in the form of commissions or like a share of the money, the capital that's invested. We make all of our money off of either selling the Fire from Real Estate program and by the co-investing club membership fees. So that keeps our incentives completely aligned with yours. And in fact, it's quite the opposite. We invest our own personal money in each one of those deals. So we have our money invested in each one of these deals. We do not get a cut of any of the capital raised for these investments. We are simply administering an investment club. What else do we have here? Another question was, can I invest more than the $5,000 minimum in these deals? And the answer is almost always yes. There's normally no upper limit on how much you can invest in these deals. That being said, it's conceivable that a sponsor could get oversubscribed on a deal. If where they get too many people try to invest in it. In which case they would set a cap on how much we can collectively invest as a club. So in that case, we would just put a cap on how much each person could invest. That being said, I've never actually seen that happen. That's never actually been a problem in our club, but it's conceivably possible. So the general answer is no, there's no cap on how much you can invest per deal, but it's theoretically possible that could happen at some point. And then one final question was, do I have to invest in every deal to stay a member of the co-investing club? And no, every single deal is totally optional. You do not have to invest in every single one of these deals. In fact, you can invest in 1 or 2 deals a year if you want. I invest personally in every single deal, but you don't have to as a member of the club. You can invest in any deals that you want, no deals if you don't want to. It's totally up to you. So on that note, we are going to wrap things up. So stay in touch with us. Hit us up. You can reach us at support@sparkrental.com. You can reach me personally at brian@sparkrental.com. You can reach my co-founder Denny at denise@sparkrental.com. Thank you guys so much for being with us today. I hope you got a lot out of this. I love talking about this stuff. Nothing gets me fired up as much as talking about financial independence and how real estate can help you get there faster than traditional investments. So thank you again. Stay in touch, and we look forward to investing alongside you soon.
Wow, what a great class that was. Most investors have never heard of real estate syndications. And even those that have, usually they can't access them. The idea of a bunch of investors pooling money together to make them more accessible, Jam, is just brilliant. And like you said, Brian, when you can earn 15 to 30% returns on your investments without having to become a landlord or actively invest, it just opens so many doors. You can build wealth so much faster than the average Joe, earning a few percent on bonds or 7 to 10% on stocks or rental properties alone. I particularly love the idea of infinite returns, and that's a pretty new concept for me. And for that matter, the fact that this is as done for you as real estate investing gets. I know you vet every deal as a club, but this is as passive as real estate investing gets, which I love. Anyway, I know that you and Denny work really hard to find the best deals to bring before the co-investing club and to put together these free classes like this one. So I wanted to take a moment and thank you. Most people in this space earn a cut of the money raised for investing, but I appreciate that you guys only earn money on the membership fees. That keeps your incentives 100% aligned with all the club members, especially since you invest your own personal money in each deal. I know my audience is in great hands when they work with you, and just wanted to acknowledge that. All right, so on that note, please visit sparkrental.com/Rick Orford right now to lock in your discounted price and get access to real estate deals that you can't invest in for this little anywhere else. It's been a pleasure having you on the class today, and thank you so much for joining, because we'll see you next time. Bye.